This actually, I think, is the biggest financial story of the world. This is bigger than they're all related. Yen carry trade I just described, that's the engine of everything. This is financing direct foreign investment in China. When you do the math on debt to GDP ratios, annual budget deficits, trends, and you distinguish between nominal GDP and real GDP, the only solution is inflation. No governments will admit it. There's strategies you can pursue with cash in terms of whether short-term treasury bills or, bank CDs. In the world we're talking about, bank CDs will pay 10%. It would say 10% gold, not 50%, but 10% will do just fine. So that's what a diversified portfolio looks like. A slice of stocks, a slice of, say, U.S. Treasuries, pretty big slice of cash, some real estate, some gold, minerals and mining. And for the stock market portfolio, I'd look at defense, medical, just because for demographic reasons, agricultural and natural resource. Why does Berkshire Hathaway have $1/3 trillion in cash? Because they see what we're talking about. They see this crash coming. When it comes, the guy with cash not only survives, but you can go shopping. The markets around the world are at or near all-time highs, and credit spreads are compressed. People don't demand much of a higher yield to buy, considerably inferior credits. So all of that is true. At the same time, you look at the other side of the ledger, the war in Ukraine is expanding. It may become an Eastern European war. The war in Iran is expanding. It's not about U.S.-Iran anymore. It's really a Middle Eastern war and beyond. China is getting more confrontational with Taiwan. No one would be surprised with political and even military tensions hotting up between India and China and so forth. So so you look around the world, and now, of course, Strait of Hormuz is closed. We can talk about all these in more detail, but commodity shortages emerging, potential shutdown of the industrial economy, at least in part because of these shortages, what it means for inflation, et cetera. So a long list of geopolitical negatives that bleed into the economy and are troubling. At the same time, stocks and other investable assets and bonds, et cetera, at all-time highs. So how do you reconcile that? They are what they are. And my analysis is, we can spend a lot of time on it, but fairly straightforward, which is that we are seeing the biggest stock bubble and the biggest credit bubble almost in history. History is a big topic, but among the greatest bubbles in history, all the factors we mentioned, the negative factors, something will come out of that.
Markets are climbing while geopolitical risk compounds, and that contradiction could become the portfolio's biggest blind spot. As Jim Rickards points out here, compressed credit spreads and record prices are colliding with wars, shortages, and supply risks. That matters because inflation shocks can damage bonds and equities together. The danger is markets pricing none of the threats investors can already see. Next, Jim Rickards reveals why this bubble can survive far longer than skeptics expect.
To pop this bubble, but we don't know exactly when. That's the hard part. Now, the Federal Reserve officials, starting with Alan Greenspan, but others have said, hey, we can't spot bubbles. We can't pick bubbles. They happen, but we don't really know when it's a bubble or when it's not. So we're not going to be in the business of popping bubbles. We'll wait until they pop on their own, and then we'll clean up the mess. That was Greenspan's approach to it. And I completely disagree with that. I would say nothing is easier than spotting a bubble. Just look at a Nikkei chart from 1989, a NASDAQ chart from 1999, current stock market charts and other indices. Nothing is easier than spotting a bubble. What's really hard is knowing when it's going to pop. They can go on a lot longer than you expect, and they often do. And I tell investors, is it a bubble? Yes. Is it going to crash? Yes. But don't run out and short the S&P 500 index, because you can lose a lot of money being right. You can be right about the bubble and the pop, but you don't know when, and you can lose money in the meantime. So what investors should do is basically don't short the index, but have a portfolio that will be robust when the index pops, when the bubble pops. So is it a bubble? Yes. Will it pop? Yes.
The most dangerous crash call is not being wrong. It is being right too early. According to Jim Rickards, bubbles are easy to recognize, but their timing is brutally difficult, making aggressive short positions dangerous. The smarter response is portfolio resilience rather than heroic market timing. Investors who prepare before liquidity vanishes have options that disappear during panic. Next, Jim Rickards exposes why bubbles can keep inflating long after fundamentals deteriorate.
Will that be catastrophic, potentially for a lot of investors? Yes, but you just don't know when. And then in other discussions, people say, well, Jim, what's the catalyst? What's the thing that's going to pop the bubble? And my answer is, it doesn't matter. And the reason I'm not being glib when I say that, it doesn't matter because it will be something. We don't actually have to know what it is. We might not particularly care what it is. It's just that you can be certain that it will be something and that the collapse will come. Now, it's likely if you said, Jim, could you give me a list? Yeah, Lucian, you could put a list together. I could put a list together. We all know what they are, Strait of Hormuz, war in Iran, war in Ukraine, credit bubble, circular lending. We all know what the list is. It's highly likely that the thing that pops the bubble is something none of us have ever thought of. And that's what happens quite frequently. It's like, and after the fact, everyone says, oh yeah, I thought of that. But the truth is, it may well be something that none of us would have on our list. But, and that's interesting, but it doesn't matter because it will be something. And that's what does matter. So bubble, yes. Collapse, yes. Catalyst doesn't matter because it'll be something. When? Very hard to say, but probably sooner than later.
The next market collapse may begin with a trigger nobody has on their watch list today. What Jim Rickards is highlighting is that investors obsess over forecasting the catalyst while ignoring the vulnerability already embedded in valuations and leverage. History shows the explanation arrives after the damage, when everyone suddenly claims they saw it coming. For savers, preparation matters more than prediction, because liquidity disappears precisely when protection is needed most. Next, Jim Rickards exposes why the market's biggest weakness may be hiding in plain sight.
So that's again, Lucian, we can drill down on all those issues, but that's kind of a big picture of where the economy, and not just the economy, but capital markets sit today, and how to reconcile sky high prices with a long list of geopolitical bad news. You're in a dangerous virtuous cycle where the money raises the price, which attracts more money, which raises the price, etc. And that's part of the bubble behavior. But the same thing is true in reverse. When that starts to go down even a little, the manager has to sell to get cash to pay the redemptions, and that lowers the price. So it spirals down with one asymmetry, which is it goes down a lot faster than it went up. It can go up for 5, 10 years in the case of the current bubble, but it can go down in weeks and months, right? Faster than people can react. And people say, oh, the market's down a little bit, buy the dips, all right? And it goes down a little bit more. It's like, oh, well, I'm right, the market's wrong, so I'm going to hang in there. And it goes down more, and then it keeps going. So the idea, people think, okay, yeah, I hear what you're saying, Jim, but don't worry, I'm so smart. I'll get out at the top. And, people don't actually do that. That's not human nature. The human nature is to deny the reality and write it down and then get wiped out. So
the market can spend years climbing on optimism, then erase that confidence in months when forced selling begins. Rickards' argument suggests the real danger is not merely falling prices, but liquidity mechanics that turn small losses into cascading sales. Fund redemptions can force managers to sell regardless of conviction, punishing investors who believe they can calmly exit later. Next, Jim Rickards unravels the hidden feedback loop that makes crashes dramatically faster than bubbles.
So my recommendation, I say this in my newsletters and books and elsewhere, is to, you'll roll your eyes when you hear this, and everyone does. I say it's to diversify, and people go, oh yeah, Jim, we know that diversification is good. They understand the theory. Diversify, but people don't understand it. I run into people and they go, Jim, I'm fully diversified. I've got 50 stocks in 10 different sectors. I've got semiconductors, minerals and mining, consumer non-durables, consumer, et cetera, et cetera. I'm fully diversified. I go, no, you're not. You may have 50 stocks in 10 sectors, but you have one asset class, stocks, and they're all going to go down together. Real diversification. Okay, you have a slice of stocks. You don't have to get completely out of the stock market, but have, I would say U.S. Treasury notes, which in a catastrophe, rates are going to go down and those prices are going to go up. You're going to have big capital gains on that. Have a lot of cash. Warren Buffett, he's kind of retired at this point, but Berkshire Hathaway, his firm, has over $1/3 trillion in cash. Why does Berkshire Hathaway have $1/3 trillion in cash? Because they see what we're talking about. They see this crash coming. When it comes, the guy with cash not only survives, but you can go shopping in the wreckage. Real estate, I would say income producing real estate, farmland, commercial real estate is probably too soon, but, apartment complexes.
Owning dozens of stocks can create the illusion of safety while leaving your entire portfolio exposed to one outcome. According to Jim Rickards, true diversification means combining assets that respond differently when liquidity evaporates, not simply collecting more tickers. That distinction becomes critical when correlations suddenly converge during panic. The investor who preserves liquidity can exploit forced selling instead of becoming another forced seller. Next, Jim Rickards reveals why cash can become an offensive weapon when markets break.
And farmland in particular, and gold. I would say 10% gold, not 50%, but 10% will do just fine. So that's what a diversified portfolio looks like: a slice of stocks, a slice of, say, U.S. Treasuries, a pretty big slice of cash, some real estate, some gold, minerals and mining. And for the stock market portfolio, I'd look at defense, medical, just because for demographic reasons. Not so much. I would say defense, medical, agricultural, and natural resource. Those sectors are going to do well. So, get your diversification hat on, do it the right way, and stand by, because the storm is coming.
All good points again, Jim. You mentioned cash. That really, I want to hear your take here. I really remember the days when cash is king was common investment mantra. Today, many people say those days will never return because inflation makes cash unattractive. So could cash become king again during the next major market correction? And would you prefer physical cash, bank deposits, or digital money?
The answer is yes. Cash can be very attractive even in an inflationary environment, because you can get some very good yields. So for example, my wife and I took out our first mortgage in, it was 1980. And we took a mortgage out to buy a condo, and, the interest rate was 13%. And my mother cried because my mother's first mortgage was like 2.5% in the 1950s.
Cash looks boring until the assets everyone considered safe suddenly need buyers. This is where Jim Rickards' thesis shifts toward optionality. Liquidity can preserve purchasing power while creating opportunities during forced liquidation. The key issue is not whether cash beats inflation every year, but whether it gives investors flexibility when valuations reset violently. A portfolio without liquidity may be diversified on paper, yet helpless at the moment of maximum opportunity. Next, Jim Rickards exposes why inflation does not automatically make cash worthless.
She said, how can you pay 13%? I said, Mom, I'm paying 13%, but inflation is 15%, which it was at the time. So my real rate was -2. The bank was paying me to be a borrower, and I was in a 50% tax bracket, and the mortgage interest was tax deductible. So I got another 8 points back on the tax deduction. So my after-tax real rate was 6 points back. My real after-tax rate was -8. It was like getting paid to be a borrower. So, and you, by the way, at that time, this again, 1980, 81, you could have bought a 30-year U.S. Treasury bond maturing in 2011 for 14%. Imagine buying a bond in 1981, maturing in 2011, that paid you 14% the whole time. And it was a U.S. Treasury security. You know, a 30-year bond's not a cash equivalent, but it'll do just fine. It's highly liquid if you did have to sell it. The point being, even in a world of high inflation, there's strategies you can pursue with cash in terms of whether short-term treasury bills or, bank CDs. Well, in the world we're talking about, bank CDs will pay 10%. They don't now, but they will in that environment. So inflation is not the end of cash if you deploy it in ways that can beat inflation. Those ways are out there. And of course, gold, we know gold performs very well as well. So there are plenty of, I'm not pro-inflation, but it's naive to think inflation is not coming.
The most important cash signal may appear when inflation is high, not low. Jim Rickards notes that in the early 1980s, nominal yields could exceed inflation, creating positive opportunities even inside an inflationary regime. The lesson is that investors should distinguish between holding idle currency and earning a competitive yield on liquidity. If inflation accelerates, savers who automatically abandon cash could miss an unusually valuable defensive position. Next, Jim Rickards exposes the hidden advantage cash provides when every other asset becomes overpriced.
When you do the math on debt to GDP ratios and annual budget deficits and trends, and you distinguish between nominal GDP and real GDP, you pretty quickly get to the fact that the only solution is inflation. No governments will admit it, and I'm not saying it's tomorrow, but cash has another benefit, Lucien, which is, and people don't appreciate this. It has embedded optionality. Mm-hmm. So let's say I said to you, hey, Lucien, I'm going to sell you an at-the-money call on every asset class in the world. What do you think that's worth? And I say, well, that sounds pretty valuable to me. Well, that's what cash is. If you have cash, you have the option to go buy stuff if the price is knocked down enough. And that option is valuable. So that adds to the value of cash. It's kind of invisible. But if you understand option theory and optionality, and that cash gives you an option to buy things at a time when everyone else is selling, you can be the buyer. Yeah. That option has value. So you have to add that to the value of the cash when you think about what it's worth in a portfolio.
Yeah, contrarian approach. Jim, what would be the first market signal you would watch for if liquidity crisis were beginning? Not the obvious signal after the crisis has already started, but the one that the sophisticated investors should notice early. I know it's a hard question here, but what's your take?
It's a hard question, but
cash is not merely an asset. In a crash, it becomes a right to choose when everyone else loses the ability to choose. What Jim Rickards is highlighting is the embedded optionality created by liquidity. You can buy distressed assets without borrowing or selling something else first. That flexibility has real portfolio value when correlations spike and prices disconnect from fundamentals. Next, Jim Rickards exposes the early warning signal that can reveal stress before headlines do.
It just got a little easier because it's happening, which is the unwind of the yen carry trade. Now, for the benefit, this actually I think is the biggest financial story of the world. This is bigger than they're all related because one thing can trigger a next and you get into a cascade, but this is bigger than what we've been discussing so far. So for the benefit of the audience, let me just explain what the yen carry trade is, and then we can kind of talk about the significance of it. It's the backbone of all global finance, but it's a fairly simple idea. So let's say you're a high quality borrower, you're a major corporation or, asset fund of some sort, and you want to borrow intermediate term for some investment. It could be a hedge fund speculator. It could be an investment bank doing M&A. It could be a private equity firm doing a roll-up, a takeover. It could be a lot of things. But you want to borrow and do a deal in U.S. dollars. What is your interest rate going to be? It's going to be around 7%. It's going to be higher than Treasury notes, but if you're good credit, not that much higher. I'll say 6 or 7%, somewhere there. That's going to be your cost of funds. What's the cost of funds in Japanese yen? Well, until very recently, it was zero. It was zero. It's been zero or negative for over 30 years.
A funding trade most investors barely notice can transmit stress across stocks, bonds, currencies, and commodities simultaneously. What Jim Rickards is highlighting is the yen carry trade's leverage. Cheap yen financing supports positions far beyond Japan, so a funding shock can force global deleveraging. That makes currency movements more important than their headlines suggest. Investors watching only equity indexes could discover the warning after the selling has already spread. Next, Jim Rickards reveals why yen funding can quietly influence almost every major asset market.
So you say to yourself, well, I'd rather borrow 0 than 7%. How do you do that? Well, but I need dollars because I want to do my deal in dollars. How do you do that? What you do is you borrow in yen. You can borrow from a Japanese bank. It doesn't have to be a Japanese bank, any bank with a Japanese yen lending facility. You borrow in yen. You pay 0%. You convert the yen to dollars spot, just call a bank or a foreign exchange deal, or you sell the yen, get the dollars, take the dollars, invest it in whatever you want it to do. And now right away, you're saving 7 points, 700 basis points on your cost of financing. And the investments I talked about are leveraged. So a hedge fund is going to be leveraged maybe 3 to 1. Private equity roll-up is going to be leveraged 10 to 1. So at that point, you're not just saving 7 points. You're saving between 21 and 70 points because it's leveraged, let's say 10 to 1. That's a huge savings just on your financing costs. That's not counting the gain on the deal. That's separate. But your financing costs could be saving 70%, in effect, adding a 70% return on equity just by lowering your financing costs. So you borrow in yen, swap into dollars, invest the dollars on a leverage basis, get big returns, and pay 0 interest. What's not to like? Well, not much. And by the way, that yen carry trade I just described, that's the engine of everything. This is financing direct foreign investment in China.
The trade looks almost risk-free while the yen remains cheap, but leverage turns that convenience into a potential systemic fault line. This is where Jim Rickards' thesis shifts. Borrowing cheaply is only half the equation because currency appreciation can rapidly erase the financing advantage and force liquidation. Recent market research continues to flag yen-funded carry as a vulnerability to global risk assets.